All right, picture this. It's 2014. You have $10,000 in cash. Where would you invest your money? Would you buy stock in Google, the high-flying tech company with lots of innovation? Or would you park that money in the stock of a steakhouse chain, Texas Roadhouse? Well, in this video, we're going to show you why Texas Roadhouse would actually be the better investment, believe it or not. I did not until I saw a post on X, and I'm doing this video to look at the data with you. All right, so let's take a closer look at these two stocks. First, we're looking at Alphabet, the parent company of Google. They actually IPO'd in 2004. And here on a one-year chart, you can see that they're up about 49% in the past 12 months. The thing I want you to look at, though, is the market cap is $1.75 trillion. So just a massive, massive company, one of the biggest companies in the world, one of the most innovative companies in the world. Now, if you contrast that with Texas Roadhouse, ticker symbol TXRH, kind of cool. They're up about 42% over the last year. But if we look at their market cap, it's slightly under $10 billion. So wildly different companies, wildly different valuations. And so it's really interesting to think about this outperforming Google over the last decade. Now, if you're familiar with Texas Roadhouse, I'm actually a fan. I go there occasionally. They're not the best steakhouse in the world. They're a chain, but they used to let you do something really cool. You could throw your peanut shells onto the ground as you're snacking, waiting for your entrees. And I think that was actually one of the best parts about the whole deal. Okay, so what does that have to do with the stock? Well, let's go over here to TradingView. TradingView, I've pulled up this chart which shows SPY, the S&P 500, and I've done this over the last about decade, okay? I'm going to turn on Google and plot their stock price over top of this. And so if you can see this okay, what will happen is you're going to watch them accumulate and appreciate in value over the last decade, a little dip here. And for that 10-year period, time range is about a 410% return. Now I'm going to toggle on Texas Roadhouse, and bam, you're going to see similar kind of uptrend, but it really starts to take off here in the last couple of years. And their stock has appreciated up to 663% return over the last decade. So about a 200% increase had you put your money in Texas Roadhouse compared to Google. Cool. So now I wanted to just plug this into a spreadsheet and kind of think about this practically. If I had $10,000 and I put it into these other stocks, what would that look like? Well, had you invested in Google back in 2004, 10 grand, it's actually returned 5,085%. So for every $10,000, you're making over $500,000, which is a pretty amazing return. Texas Roadhouse here is also pretty impressive, right? With 1,184% return. 10 grand will get you 118. But I also remember Domino's as being this kind of stock that did this massive rally and turnaround. Domino's Pizza, of all things, 10 grand would have gotten you a $295,000 total return. Pretty crazy. So would you have picked these stocks if you were just picking out single investments? I don't know if the answer would be yes. We could go much deeper into sales and profitability and all kinds of other, technical aspects, but that is not what I necessarily do on this channel. I'm just looking at stuff on a high level that's interesting in the financial markets with investing, and that's why I wanted to dive into this story. All right, so now that we've taken a look at that, what are my own thoughts on this? I think this confirms one thing I talk about a lot. Would you really have been able to predict that Texas Roadhouse performed this way? It's hard to pick stocks, and only after the fact do we think, oh, I've eaten there. I know that brand. I understand that company. I could have put my money there. Why didn't I? I'm not going to let that happen to me again. And the fact is, it will happen to you again, because if you try to pick and place your positions with stocks, it's really, really challenging. I think that because we're so familiar with brands that do take off and have a lot of success, it makes it seem a little bit more identifiable or easy to predict compared to something totally random like numbers in a lottery. But the fact of the matter is, it is that hard to predict the market changes and which companies will win and which will lose. So one of the more safer approaches to investing would be in index funds and through other ETFs that have a lot of companies in one single investment. If you like this kind of stuff, click subscribe. I'll see you soon.